Diversify at retirement to convert from tax-deferred to tax-free accounts. In this episode, I'm going to address how to have 60% of your income be totally tax-free at retirement. Get ready. You're going to gain insights into some opportunities that maybe you didn't know existed before. So my name's Doug Andrew, and I've been a retirement planning specialist now for more than 48 years, helping people plan for a comfortable retirement to hopefully not outlive their money. And in doing so, I've been very passionate about helping people balance their lives and be able to have a long, productive life and not have to worry about the money. Because so many people realize when they approach retirement that they may outlive their money because of what they've been doing with it under traditional financial planning and advice. So the purpose of this episode is to help you break free from what I call the retirement tax trap and make yourself immune from inflation and taxes and market volatility. So get ready. I'm going to use some PowerPoint illustrations to help you get it. So during this nearly 5 decades, I've noticed that a lot of people may accumulate $1 million, $2 million, $5 million, $10 million. It doesn't matter. But so many times they have been following the herd, putting their money in traditional accounts like IRAs or 401ks invested in the market. And as they approach retirement, they go, well, wait a minute. I've always been told I was going to be in a lower tax bracket when I retired, and I'm in as higher bracket as I've ever been in. Yep. I could have told you that 30 years ago because you're a saver. Most people who save money are not in lower tax brackets when they retire. And they've been basically going down the highway with one foot on the gas pedal and the other foot on the brake pedal, and they didn't know they were doing it during their entire life, putting money into traditional tax-deferred IRAs or 401ks, putting off tax, and then killing their deductions by paying off their house. When they're retired, their kids are gone, or if they're not gone, you can't deduct them anymore. Yet they were a business owner, you don't have those deductions anymore. You're not contributing money to IRAs or 401ks during retirement. So people find themselves in as higher tax brackets because they don't have the deductions anymore. And Congress keeps raising taxes. So there's 3 big dangers that cause most retirees to outlive their money. Taxes, and they're going through the roof right now if you can't see the writing on the wall. Inflation, which I call a hidden tax. It affects everybody because it erodes the purchasing power of every one of those hard-earned dollars away. And at the current real rate of inflation, as of the recording of this episode, November of 2021, the real rate of inflation is more like 14-15% because of all of the costs that have gone up on the average, meaning the cost of living will double about every 5 years. So inflation will cause a lot of people to have to take out twice as much money out of their IRAs or 401ks every 5 years to buy the same gallons of gas and loaves of bread that they used to buy for $100,000. They're going to need $200,000 in 5 years. Okay. The third is market volatility because we're headed for topsy-turvy markets because of fiscal and monetary policy of the government and spending. So those are the 3 big dangers. I like to make my clients, my students, immune from these 3 dangers. We do that by seizing 3 opportunities. Number 1 is to convert as much as possible of your money to tax-free vehicles. And I would recommend 40 to 60% of your income not even show up on your 1040 tax return at retirement. I'm going to show you how to do that. Link your returns to the things that inflate. I don't like inflation any more than you do, but it doesn't hurt me. It helps me because the things that are inflating, I'm benefiting from, and a lot of financial advisors don't know how to do that one. And third is to use indexing, which is a strategy, and I'm not talking about index mutual funds. Indexing allows you to participate when the market goes up, the economy's doing well, but not lose one dime when the market crashes, because your money is not invested or at risk in the market. So those are the 3 big opportunities that we teach in our educational events and in our various books. And stay with me. I want to gift you a copy of one of my books at the end of this episode. Now, the 3 greatest strengths of my favorite financial instrument, where I would recommend 40 to 60% of your retirement assets be repositioned to. It's what I call the laser fund. Laser is an acronym that stands for liquid assets safely earning return. And that's liquidity is the L in laser, the ability to access your money when you need it. And I prefer tax-free without incurring penalties and so forth. Number 2 is safety of principal, not just safety of the institution, but any money I set aside, I want to be safe from losing that in the market. And any year that I make money, I want that to become newly protected principal. A lot of advisors don't know how to do that. And then to earn predictable rates of return that historically has beaten inflation. Be able to row upstream at the rate of 7, 8, 9, 10 miles an hour so that the current of inflation will not negate that. Because if you have your money in a bank or credit union or in the market and you're rowing upstream at the rate of 3 or 4 miles an hour, the current of inflation is coming down greater than that. So those are the 3 strengths. Now, what I want to do is go into the 4 incomes that many Americans will draw from. Not everybody draws from all 4 of these incomes, but I'm going to share these with you and give you some insights into what ratio I think you ought to diversify your hard-earned money at retirement, because at retirement planning is something totally different than maybe what you did for retirement planning. And stay with me. I'm going to share with you why you should subscribe to this channel, because I have all kinds of educational videos. And there's over 500 on this 3-dimensional wealth channel. And when you subscribe, because it's free, be sure and click the little bell, because then you'll be notified every time I post a new educational video, which I do almost on a daily basis. But be sure and share this with somebody who you think would be interested. Click like or post a comment, but stay with me to the end, because I want to gift you a copy of my 300-page book, The Laser Fund. The 4 incomes in retirement: investment income. Some people have real estate income because they own non-owner occupied rental income real estate, guaranteed income, and tax-free income. This is the most underutilized and misunderstood one, and it's my favorite one. So let me go a little bit deeper into these. This purple bucket, I call it, these are buckets where people have their money. I would find that many people, as they approach retirement, would be way too top heavy in this bucket. They would have 80 to 90% of the retirement resources in a tax-deferred environment, in like an IRA or 401k or a 457 or a 403b if they were a school teacher, in yet-to-be taxed IRAs or 401ks invested in the market. And I would go, what are you thinking? But they had their blinders on. Their head was like in the sand, and they were just following the herd, putting money in the company's 401k. And now they had sort of trapped themselves in this tax trap. They have to pay tax on this, and they're not in a lower bracket. So they were way too top-heavy there. Some people have real estate. Others don't. They just own their home. Maybe they don't even own a home. But I found a lot of those that had rental properties, as they approached retirement, many times they were sick and tired of being a landlord, fixing toilets, evicting tenants, taking out the trash. But they were trapped because if they sold it, they'd been doing 1031 exchanges for years, postponing, and now it looks like under the Biden administration, they are going to possibly do away with the step-up in basis on long-term capital gains, and they're going to gradually increase those capital gain taxes from 20 to 25% up to the ordinary income tax rates of 40% or more. So it's not going to do any good to have had those pieces of real estate. But people are shocked when I show them how to maybe sell. Take the net after tax and put it into a portfolio of tax-free buckets, the laser fund, and they're like, this is generating as much or more income as my real estate properties have ever done, especially after tax. And I don't have to be a landlord anymore. Where have you been? And I said, oh, I've been here all along. But they had their blinders on, okay? Now, if you do keep them, I can show you how to leverage them better to increase the liquidity, safety, and rate of return. Now, the orange bucket is what we call the guaranteed bucket. This is usually like a defined benefit pension if you were a school teacher, a police officer, a firefighter. It could be your Social Security benefits. But if you have a very low risk tolerance, or rather you are adverse to high risk, sometimes you can put your money in an annuity, an indexed annuity. There's only 2 that I would ever consider, and I've never owned an annuity, and I doubt I ever will. That's a savings account with an insurance company. But there are annuities that will allow you that if your money runs out at age 85, 86, you will still get income if you live to be 120. And so that's for those people who want a guaranteed bucket. You may not get as high of an income, but it will never run out. And sometimes people are more concerned about the return of money, or they don't want to be rich, they just don't want to ever be poor, okay? Now, my favorite bucket is the green one, the tax-free bucket. It's the most underutilized. In this one, you could have municipal bonds, but they're not very popular anymore because there's so many municipalities that are mismanaged and they're going bankrupt. And so they're not high yielding. Roth IRAs or 401ks. Now, I've never owned an IRA or 401k, never will. But I've never owned a Roth IRA or 401k, and I never will, because I can have the two benefits of a Roth. My money accumulates tax-free and I can access it tax-free, plus 4 additional benefits that Roths will never have if I utilize a laser fund. And I'm going to gift you a copy of the book so you can understand what this is. But let me show you what it does. Now, because so many people are too top-heavy in the purple bucket, one of the strategies that is most popular, okay, is a strategic rollout. This is not a rollover. That's like going from the frying pan into the fire. This is taking money in 401ks and rolling it over to IRAs and postponing, if you don't need the money, until you're age 72. And then you take out RMDs, required minimum distributions, thinking you're saving tax. That is the worst advice I've heard for most retirees, is to take RMDs. I have software that shows you how much tax you will pay in the long run if you keep postponing and delaying and having Uncle Sam as your partner to be able to have a piece of everything that will ever earn as long as you string it out. That is not smart. So it requires a rollout. You want to get the money out of the purple bucket, get the taxes over and done with sooner than later in today's tax brackets, rather than think tomorrow's are going to be lower. They're not. Number 2, you don't have to live on that money. You get it out and the taxes over with, and reposition the net after tax monies down here to the green bucket, so it's tax-free from now on. And you will learn how this, when you ultimately die, reimburses you manyfold for any taxes you paid during the rollout. It's incredible. But you want to then offset some or all of the tax by resurrecting new deductions. There's strategies to do that. But that's called a strategic rollout, and it's explained in the book. I would recommend that at retirement, no more than 30% of your assets or income should still be in that purple bucket. And I've had many people that have 0 in there. They've taken out 100% of it because that's subject to market volatility and taxes. I would recommend, if you own real estate, that no more than 30%, less than 30% of your income should come from that bucket. If you are very conservative, I'd recommend no more than 80% at the maximum, but somewhere between 0 to 80% of your income could come out of that bucket. But here's the one that most people benefit from the most. I would recommend between 40 to 60% of your income in retirement not even show up on your 1040 tax return. People go, is this legit? Yeah, let me show you the numbers. We've had couples come, and you can extrapolate from this example, and they'll say, you know what? We have saved and saved and saved. Between us, husband and wife, we have, 2.6 million accumulated. We calculate that we can pull out $160,000 a year out of our IRAs and 401ks. And on top of that, we have $40,000 coming from my school teacher pension or from Social Security or whatever. We have $200,000 of income. And I go, way to go, but I do see one big problem. And they go, what's that? And I go, well, it's all showing up on the front page of your 1040 tax return. And they always go, you mean there's a better way? And I go, yes. And they say, well, where have you been? I said, I've been here all along. You've had your blinders on. See, you're going to pay $54,000 or more in taxes every year the rest of your life. You're only going to net $146,000 to buy gas and groceries, and pretty soon you're going to need twice that to buy the same gallons of gas and loaves of bread because of inflation. In other words, I can, in 5 years, do a strategic rollout. And we have done this after 4 years and 1 day, okay? They still have $200,000 of income, but we have successfully taken $120,000 of the $200,000 off of their 1040 tax return. The IRS still know they're receiving it, okay? They know everything. but it's tax-free, and it's been tax-free for over a century in the Internal Revenue Code. What's the difference? They're only paying $21,600 in tax. They are netting $178,000 to buy gas and groceries. We save them with that one strategy, $32,400 a year in tax. And if tax rates never go up, by the time a husband and wife pass away to their life expectancy, we have saved them $810,000. Because taxes keep going up, most people, we save over $1 million with one strategy called a strategic rollout. So those are the percentages that I recommend. And if you want to learn more about this, these buckets are explained on page 220 of this Laser Fun book that I'm about to give to you. And I'm going to share with you how you can claim your free copy. If you would like to learn more about this, this is a 300-page book, The Laser Fund. Simply go to laserfund, L-A-S-E-R fund.com, or click on the link below. And you can contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that expense, and I will pay for the book and fire out a copy to you. There's also options there to listen and learn, watch and learn. There's even an 18-hour masterclass that you can enroll in, but to get a huge discount, to be able to get it at only 20% of retail, be sure and check out my virtual course that I teach on a regular basis called Retire by Design. And when you go in to claim your free copy, you'll get a substantial discount to be able to enroll in that education. And when you do that, you'll be able to get the 18-hour masterclass on this for only 20 cents on the dollar. So again, I want to empower you, get your free copy. And when you do that, there's other books like Entitlement Abolition that's very popular. And you can have the same deal there. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that. So here is to your brighter future. And I hope that you'll be able to reposition your assets so that you will not outlive your money. You'll be diversified into superior vehicles.